Hi, I'm Rudy Luco with Morningstar Canada. I'm here with Paul Bosse, a principal with the Investment Strategy Group at Vanguard Group, the US-based fund giant whose operations include a TSX-listed family of ETFs. Today we're going to be talking about home bias in investing. Paul, welcome to Morningstar.
Pleasure being here, Rudy.
Our home market here in Canada has a lot going for it. We have a very strong banking sector, resources wealth. We don't have any tanks or troops massed at the borders. But your research suggests that Canadian investors are a little too fond of the home market.
Well, it's a fine place to live and be, and what we find is that Canada only makes up about 5% of the world market cap. And as a consequence, there are some opportunities that lie outside the borders of Canada that perhaps Canadian investors should take advantage of.
Mm-hmm. Now, in terms of sectors, in what areas is Canada lightweight compared to the global market as a whole?
Yeah, good point, Rudy. I mean, really, people are recognize where they're overweight. You know, they're high in energy, they're high in raw materials, they're high in banking as well. Often people forget the areas that they're light in, and that is consumer products, healthcare, as well as information technology. And that went a long distance to explaining what happened in 2013 when the TSX still had a good year, up 10%, but the S&P in the US was up 30%, and the world was up about 23%. So it was those sector differences that lead to a different type of performance relative to the rest of the world.
Mm-hmm. So if you invest globally, you have a greater choice of companies in different sectors. That's the main point.
Also true. I mean, it is a concentration issue as well. So Canada has about 330 names that you can invest in. The world has about 8,500, so a much broader palette to choose from. And in addition, the top 10 names in Canada represent about 36% of the cap, whereas for the world it's only about 7%. So a great deal of concentration, but also a limit to how many stocks you can consider.
Mm-hmm. Now Canada, compared to, say, emerging markets, a pretty liquid market, but not the most liquid in the world. Compared to some of the largest markets. So what implications would that have for investors? Yeah,
good point. It's not too different from, say, the UK or Australia, but certainly much less liquid, say, the US, or when you compare it to the world. The other point is the bid-ask spread is much richer. Say, it's almost 10 times richer, or wider, I should say, than it is in the U.S. So, yeah, there are opportunities overseas that, that would pay off in that regard as well.
Mm-hmm. So the difference between the bid and the ask, that's really an additional cost of investing, isn't it?
Exactly right. Mm-hmm. Exactly right.
Now, we've talked about stocks. What about bonds? What about home bias on the part of Canadian investors in the fixed income markets?
Right. It's the same sort of issue. So on the equity side, Canadian investors tend to own somewhere between 60 and 65% of their equities in Canada, whereas the weight is only 5%. In bonds, it's even further than that. They own nearly 85 to 90% in local bonds, and yet Canada makes up less than 5% of the bond situation. People often think, well, bonds, I'll just buy those local because I know interest rates move in the same direction. Well, they do tend to do that day to day, but if you lengthen out the horizon, the time horizon, say to 10 years, that correlation between interest rate movements drops to between 0.4 and 0.6. That is a great opportunity to have diversification. If diversification works on the equity side, it ought to work on the bond side as well.
Now, one of the biggest impacts on foreign bond returns has to do with currency movements. So what do you recommend do you recommend hedging or not hedging?
Right. Well, it definitely is hedging. I mean, the problem is that interest rates are often connected to the movements of currencies, and the volatilities tend to be additive. So if you looked at, say, a international or global bond unhedged, it would have higher risk than a Canadian bond. But if you look at it hedged, the volatility drops to about a third. So suddenly it's much less volatile. It is the preferred way to go, because if you don't hedge it, you're really ending up with a currency instrument as opposed to a bond. Mm-hmm.
Although I guess there's one school of thought that says, well, if you don't have all of your money tied up in Canadian dollars, you're getting something of a currency diversification.
Well, it could be, but again, remember the volatility that you're talking about, and you better be right with that forecast, by the way. And forecasting, it's a dangerous subject.
Now, you recommend hedging on the fixed income side, but what about equity exposure? Hedge or not hedge?
Well, there it depends. I mean, the fortunate thing on the equity side is that you have so much volatility in the stock market, and there is not that direct connection between direction of interest rates, which is true for bonds, and currencies. So if you look at the correlation between currency movements and equities, it's virtually zero. It's at the levels of noise. So it's almost agnostic. It can go either way, but certainly it won't add to the volatility like it does on the bonds.
Paul, thanks for coming in today and for your comments and insights. And thank you for watching. For more on investments and personal finance, keep coming back to morningstar.ca.